When the economic environment becomes uncertain, we provide the truth from a breadth of perspectives to help people make decisions. We not only compile and analyze the data that moves our ever-evolving economy, we carefully craft our own to provide clarity across industries, businesses, and employment markets. We identify unique opportunities to deliver asymmetric returns and focus on capturing value created during periods of higher volatility, transforming the financial landscape together. We're MacroEdge.
Good afternoon, everyone, and welcome to MacroEdge Radio for Friday, January 31st, 2025. Anything interesting happened today in the markets of the world? Because wow, was the month of January insane. No other words for it. We'll hit the markets real quick as everybody logs in and joins the room. Then we will join our special guest and begin an intense, in-depth discussion because, folks, there's a lot to talk about in the world of commercial real estate and impacts on residential, along with the financial system. And Lonnie Hendry with Trepp will join us. Quickly, though, to get through the markets, and what a day it was as the tariff wars have begun. And no, I'm not going to do it like Yoda just to make some of you laugh at my terrible accent. Dow down 337 to 44,544. NASDAQ down 54 to 19,627. S&P down 30 to 60.40. This was a result of a turnaround during a press conference where Trump decided to drop 25% tariffs on our neighbors of Canada and Mexico. 2-year up 3 ticks to 422.8. 10-year up 6 ticks to 457.4. 2s 10s up 3 ticks to 34 basis points. The big money watch, USD JPY, Japanese yen, almost up a full stick to 155.16. It's crazy that we saw that move, and it's a warning that the world does not approve what's going on. Gold down $15 to 28.29. Silver down 29 cents to 32.20. Oil and Brent were flat. Who cares? The Widowmaker flat at 305. The most panic-stricken commodity in the world, and this is a major concern for yours truly, because God knows if I'll go postal. Another all-time high in coffee, up 450 to 377.90. And I will warn you, I cannot be responsible for what happens if we get to 400. With no further ado, I would like to invite Lonnie Hendry on to MacroEdge Radio. Lonnie, how are you doing, sir?
I'm great. Thanks for having me on. Looking forward to the discussion today.
I am too, sir. I am too. So please, for those who are not aware, who did not hear the MacroEdge interview on Trepp, please introduce yourself, give us a quick background, the website, what you do, and then we're going to dig right into this as Ulysses Awesome is joining us for the program tonight.
Perfect. So my name is Lonnie Hendry, Chief Product Officer at Trepp Inc. We're a New York-based data and analytics company that tracks the commercial real estate and CMBS markets. We've also launched into the corporate credit space as well as CLO product. I oversee our product development, 20 plus years in the commercial real estate landscape, teach at a couple of colleges, live, eat, sleep, breathe, all things real estate, and looking forward to the discussion today.
Fantastic. And folks, you can find everything for Lonnie at Treppwire. And I will tell you, it's at Treppwire on X. You cannot miss it. Trepp.com, Trepp.com. Check it out. The information they provide is outstanding. It gives you insights you're not going to find elsewhere. So I'm going to start it off since the tariff subject has already hit. Is there a concern, or have you done any analysis on what the impact of a tariff war might have on currency instability and foreign investment in American commercial real estate?
Yeah, it definitely probably reduces the appetite. We haven't done a lot of in-depth analysis at this point just because everything is a little bit hyperbole at this point. Like we don't know exactly what will play out. I think our chief economist, Rachel Szymanski, has put out a couple of pieces over the last month or so talking about the inflationary pressures that a tariff war could have on the U.S. economy broadly and how there could be some downstream implications on commercial real estate, mostly in the form of increased labor costs and some other operating expense pressures that the industry doesn't need. I think the foreign capital question is a very interesting one in the sense that U.S. has been considered a safe haven for offshore capital investment. And if we start seeing tariff wars going back and forth, potentially that lessens the appetite for foreign investment, which could have some significant impacts on CRE broadly. but I think it's a little bit early to speculate what that would look like. I still think, all things considered, people are going to view making capital investments in United States real estate as a favorable option relative to some of the other options that they may have in other parts of the globe.
Can't disagree with that at all. We're also seeing some initial impacts from the deteriorating loonie, which is a major problem and crisis in Canada, especially when it relates to investment in Florida real estate, as well as second homes for individuals. I don't know if that's any area. We had Daniel Foch on a couple of weeks ago, and he was concerned that if the loonie continued to deteriorate, they may have to pull back just because of the affordability issue. Is that something that is in your consideration when you talk about foreign capital investment into the United States?
Yeah, I think that would be an example, and I think it's important to look at this from the perspective that it could be very granular in its impact. So you talked about Florida and some of the second home investment. We've seen anytime there's large macro economic disruptions, some of these wealthier markets where people don't make their homestead there are the first ones impacted and can maybe be a canary in the coal mine, if you would, in terms of what some of the broader implications could be. So I wouldn't be surprised. Florida's got some other challenges as it relates to the condo, with the condo collapse of a couple years ago, the increased scrutiny and building guidelines that went into play. There's going to be some pushback in terms of people wanting to put additional money into condo development, condo maintenance, et cetera, in Florida. So notwithstanding the currency challenges, notwithstanding tariff, I think there's going to be some potential impacts to Florida that are negative. We actually did a webinar yesterday, and it was interesting. If you look at the CMBS multifamily debt space in Florida, Miami has a pretty large amount of apartment complexes that are struggling with delinquency and debt service coverage less than one. So what you would imagine to have been a fairly strong market, given all the headlines, the migration patterns, and everything else. Florida has shown some challenges on the housing side already, even notwithstanding any of the tariff discussion.
That brings us back to places like California, also, where you have a much more stringent regulatory environment. I fear that the distortions created by this, and I'm a Floridian, so I have to speak from my own personal experience, is that you'll see areas that will want capital but have problems like you described in Florida, whereas other areas are going to have regulatory problems or affordability issues. That's just going to make it impossible to make any kind of decent profit. That brings me around to the next question, though. Did your economist or anybody take a look at the potential of a Liz Truss moment? My theory for 2025 is that instability breeds instability. Our president is bringing it out in spades. Do you see that as a risk of a Liz Truss moment where it creates distortions in the bond market and creates financing issues?
Yeah, I mean, I think we've already seen at some level, what people refer to as the Trump trade playing out. We've seen the Fed pivot. We've seen the federal funds rate, notwithstanding yesterday's FOMC meeting, where they decided to hold rates steady, three, previous rate cuts. But the Treasury yields have not moved at all. And I think it just kind of speaks to where we are in the market, where there's just some uncertainty. Obviously, the election took place in November. The inauguration and swearing in of the new administration doesn't happen until January. So you effectively had a period of a lame duck president in place. Now that we have the new administration in place, they wasted no time in signing executive orders and kind of pushing their agenda forward. And I think it is going to take some time for us to see just what and where and to what extent people think some of this new agenda, both fiscally and with immigration and other things, what are the downstream implications? And so you could have some dislocation in the marketplace. I think on the positive side, CPI data has come in this month and not jumped off the charts. I think there are some positive things that saying, even with some of the uncertainty, the markets are still operating at a level that people would expect. But I wouldn't be surprised. There's a couple of these linchpin initiatives that have been touted that if one or two of them go off the rails a little bit, you could see some real market instability and people maybe making bets and doing things that the economy and the markets haven't seen in a while.
Well, based on all this, just a curiosity question, because I don't analyze this part of the world as much as I probably should, but I'm more in my own backyard. Is Europe a dead zone for commercial real estate investing at this time until they restructure their banking system? I'm just curious off the top of my head.
Yeah, I think there's been a little bit of a resurgence over the last, call it 3 or 4 quarters, where you started to see capital flows a little bit better there. But I think broadly, as we started off the conversation, if you're somebody looking to place capital, at scale, it's not going to be in Europe. Like, you're going to put your money in North America and the US. And I think, generally speaking, even with some of the uncertainty that we have here today, people still view us as a favorable location for investment. So, you know, one could maybe hope that some of the economic agenda, some of the fiscal policy, and some of the moves that Trump and his team have implemented and have threatened to implement going forward could potentially act as a catalyst for some of the potential needed changes in the European markets. And you might see their governments being a little bit more proactive and trying to keep some of that investment in their home countries. We'll see if that plays out. I am pretty bullish in the sense that I think the markets are poised for some change. Now, whether, I agree with everything that's being rolled out here locally in the US or not, we can have that discussion sometime else. But, I do think that people are ready for some change, and hopefully that change could maybe buoy some of these locations that haven't had investor appetite whetted in a while, and maybe they can, bring Europe and some of these other places back to where people are willing to make long-term capital investments there.
Yeah, there's been a tremendous amount of investment in Mexico, especially in the recreational or hotel resort investing side of things. And I think Mexico is still primed for it, all, of course, depending on the relations that are developed over this year and forward with the administration. Uh, does the migratory stasis, which we see basically paralyzed right now because the difficulty in selling homes, existing homes, do you see that as being a major issue impacting CRE in the formerly hot markets of the Southeast, Southwest, et cetera, until it frees up and they're able to sit there and start moving these existing properties? Is that going to be an issue moving forward? Because we're starting to see a lot of bankruptcies for retiree homes, nursing homes, et cetera. It's like a domino effect as we're moving forward.
It's really interesting. I have to say I've been a little bit surprised at some level of just the resiliency of the marketplace. If you look at, and we'll look back at this time period over the last 5 years or so with COVID, and we basically lived a lifetime in 5 years. If you look at headlines and if you look at all the stuff that's happened with lockdowns, vaccines, work from home, um, presidential administration challenges, all these things that have all happened in a very short period of time. But the market has remained really resilient on the real estate side. Now, some of the challenges with the Federal Reserve in 2023 deciding to, start raising rates to try to get inflation under control. You saw a 500 basis point increase in about a 15-month period, which was unprecedented, but it didn't have the broad impact immediately that I think they nor the economists thought it would have, in the sense that about, call it 70% of the US home owner market have locked in fixed rate mortgages at less than 4%. So as the interest rates started to rise and new money mortgages would cost 6, 7% to finance, your existing homeowner stock were baked in at something in that 2 to 3% range. And so you didn't see, a huge impact to them. Now, on the commercial side, you definitely did, but on a relative basis, the commercial market is not the same size and scope as the residential market. And the commercial market, obviously, there's a little more flexibility in payment. There are interest-only loans that you can extend out for a year or two. We've seen a lot of modifications, extensions, and other things to keep that market still functioning. To your question of, like, some of the Sun Belt states in the southeast, yes, potentially some of the immigration stuff, some of this disruption that we've seen is going to impact that. I think what we're seeing now is the impacts from 2023 taking itself 2 years to kind of get to the market level where the excess of home inventory is starting to really blow up, and home builders, which have been able to subsidize home buyers by paying down the mortgage interest rate and doing other incentives to get them to make a purchase decision, those incentives maybe aren't as appealing at this point as people worry about the macroeconomy and inflation maybe coming back or the stability of their job. And so I think if I was taking an academic approach and I was answering the question, I would say certainly like there's going to be challenges. There's going to be some areas that really are negatively impacted here. There's going to be more bankruptcies, more foreclosures, all of this stuff that we would have expected, I think, at a much higher clip than what we've had over the last 5 years. But as I say that, I'm reminded of just how resilient the market has been over the last 5 years. And I'm also cognizant of the fact that we have a president now in office that is a real estate developer by trade. And it seems and feels like every time there's been some sort of major catastrophic event that could potentially bring down real estate, whether residential or commercial, post great financial crisis, the government has intervened at a level to prevent that from happening. So whether it be bank failures, whether it be, a long list of items we could go through, I think I just wouldn't bet against the resiliency of the real estate markets, even though the data may suggest that we're at an inflection point.
Well, we're still seeing a lot of flux in the logistics and transportation arena with what Amazon's talking about, discussing and shuffling their closings and openings and moving their markets around. Let's move through the various arenas, starting with office space. We're seeing such a distortion. There's a story from Nightingale, a post from Nightingale Associates talking about a Minneapolis office building sold for 3% of its 2016 price. That's at the extreme. Whereas you have other stories, especially I'm going to go from the Commercial Observer, where recaps are hot and heavy and reinvigorating places like New York and other areas. Is it a regional by regional issue, or is it more where uh, people are being forced to return to work, hence the need for that office space, hence the demand? If you recap it, make it more profitable, it will live. If you are in the boonies, Minneapolis, Omaha, and God knows where else, you're going to be a victim of your location.
I have to be careful what I say here because on our podcast, which I did not do a very good job on the introduction of shouting out our podcast. I'm gonna do that real quick here. So our podcast, you mentioned it, Trepwire podcast. We're over 300 episodes. We're approaching 2 million listens. It comes out every single Thursday. It's a weekly edition. And on our podcast, we have not missed a week since March of 2020. We've been able to publish an episode, at least one episode per week since March of 2020. And we actually had a listener email in maybe 60, 90 days ago at this point that said I was too hard on the Minneapolis market and referenced it as something inferior to some of the other markets. So I have to be a little bit careful, but I agree with you at some level. These secondary and tertiary markets are the ones that are really feeling the impact. If you're in New York, obviously there's investment appetite there that just can't be matched anywhere else. Now, for office on the whole, I think this is a great time for me to kind of, if you take one of my classes in school, the first week of class, I tell them two things. I say, one, real estate by definition is cyclical. It's always been cyclical. It will always be cyclical. At this point, the government intervention has prolonged some of the cycles, and we haven't started to see the downturns that we would normally see without intervention. And you could debate whether that's good or bad. I happen to think it's not on the good side. The other thing is that real estate, by definition, is a local, and I would argue a hyper-local endeavor. You could have two buildings on the same street that have completely different outcomes based on who the owner, the operator, the management company, what their debt load looks like, et cetera. So when we look at headlines broadly, it's important to kind of keep that perspective that real estate, while it may appear certain regions are performing better than others, or it may appear that certain owners are doing better than others, it really comes down to the local market, the market participants that make up that market, and the fundamentals that drive value. And obviously, larger markets, New York and others, are going to have some of the strongest fundamentals broadly just because of the availability of capital and the diversity of people that are there. Whereas in some of these other markets, they're challenged. So I'm pretty bullish, honestly, and as we look out through the rest of 2025, I think you're going to see office come back in most of these markets where you have the return to office mandate and you have debt funds and other capital providers that have to make investment. I think we've kind of troughed out in the office, um, pricing, and I think you're going to start seeing select markets by the end of 2025 really coming back and it being an investable asset class. for these secondary, tertiary locations that maybe have historically had really large insurance companies or other type of headquarters in their location. I mean, we've seen that with Detroit going all the way back to the 60s. I mean, it's lost population since I think 1960s because they were too concentrated in one industry. And I think Minneapolis is one of those. Like they have United Healthcare and some of these other large insurance firms. They're probably not ever going to need the office space that they did. And if they don't come back to those offices, I don't see a large draw from other private sector companies coming in and just clamoring to fight over Minneapolis office. And so I think it's going to be the tale of two realities, and I think both can be true. You're going to have some markets that remain struggling, and you're going to have their offices continue to go down in price. And then you're going to have others where we've already bottomed out, and by the end of this year, you're going to see not maybe return to pre-COVID use of offices, but pretty darn close, in my opinion.
Do you see a risk in these secondary markets of investors, especially on the private equity side of things, gambling a little too much once again and putting parts of the system at risk, especially in the regional and community banking area?
Yeah, I mean it's an interesting question, and I think it's the private equity approach or the financial engineering approach to basically everything that we do or consume or use or drive past or whatever is problematic at some level because they're not looking at some of those underlying, drivers of value at a granular enough level to actually see if it makes sense. If a top line makes sense, they do things in local markets that maybe don't work, and they're willing to have some losses on those as long as the overarching plan does. I think these secondary markets that were, buoyed by work from home, the kind of Airbnb mentality where people were renting properties or buying second homes in these secondary locations, I think you're going to see a real pullback in that. And in a lot of markets, you already have North Carolina as an example, and Idaho, like some of these markets that um, never had really been on the radar for large scale real estate investment that jumped off the page during COVID. You've seen a real pullback there. So I definitely think there's some risk. And so I don't want my optimism to overshadow the reality that we're in terms of there's a lot of pressure in the system. I mean, if you look at auto delinquencies, if you look at student loan delinquencies, if you look at credit card balances, if you look at people just making the minimum payment on their credit cards, as a percentage compared to other times in history, all of those things are elevated. So the cost of goods, I'm not a believer in the broad brush CPI prints that we push out. I think it's an archaic measure. Inflation is still here for most of America. Any and all of those things, if they break through the dam a little bit more, could be really, really challenging for a lot of different sectors, including real estate, including some of these broader PE use cases. But up until this point, it's amazing just how resilient the American consumer has been and how resilient, as I mentioned earlier, the real estate markets have been as well.
I think in the end, like you said, local markets, especially when you're able to microanalyze particular properties, is the only successful way if you're going to get into that investment. Ulysses Osman knows more about this than I do. It's not my field of expertise by any stretch. However, when you look at what's going on from Florida, we still have seminars on how to invest in mobile homes. That's how insane we've become down here, believe it or not.
It's this hyper consumer world that we live in where now information and social media has become some form of currency where effectively if you're brave enough to get on camera and you can project yourself as an expert, people will pay you for classes, people will pay you for advice, some of which may not be legal or advantageous financially. And so it's an interesting time that we live in, and I do think, like, to your point, there's some people have been able to do really well within certain sectors, and they just expect that to scale across the U.S. And on the real estate side, in particular, it just doesn't work that way. I mean, the local drivers of value are different in every market, and we see this every single day. I mean, I live in the real estate world where we're tracking data every single day, and it's amazing how you can have offices in one market already coming back and then, still losing value in others. You can have self-storage properties that the new construction supply have been so grossly overbuilt in some markets that it'll probably take 10 years for those to hit some form of equilibrium. And then there's other markets that still need it and people can go in and make a lot of money. And so if you're not familiar with the market, if you don't know the supply and demand drivers and what people want, to your point earlier, it does add some additional risk into the system. But unfortunately, people are always looking for a way to try to make a buck. And, real estate in particular is one that people have always kind of gravitated to be able to make big profits. And so, as long as that continues to happen at some scale, I think you're going to see continued investment and people trying to become a guru or a master class provider, et cetera, when they probably don't meet the qualifications.
Which is somewhat terrifying because at some point I could see the tokenization of short-term rentals, and God help us. God help us when that
It's
happens.
listen, it's going to happen.
Oh
I'm
no.
surprised it hasn't happened at this point. I mean, since we're in the prop tech space, I mean, I'm meeting with folks looking for new and exciting ways to try to, you know, put real estate on the blockchain to create tokens and to do all of this stuff. And it's amazing just the disconnect between some of those new capabilities in the market and maybe what some viable uses of like a blockchain or something would be for real estate and how people are trying to make a quick buck off of it with some of these new concepts. It'll be interesting to see what happens. I think for everything that I mentioned earlier of us living a lifetime in the last 5 years, I think with AI, I think with the blockchain, with tokenization, I think the next 5 years is going to be just as crazy, but hopefully in a positive way.
I hope you're correct. So let me take a quick commercial timeout, folks. MacroEdge.net/ozone, MacroEdge.net/ozone. Grab your 2-week free trial. Read more fascinating information from our team. Also, get access to finding out who's coming up with great guests like Lonnie and the Trepp team. This is your opportunity. Take advantage of that. And don't forget, Trepwire, the podcast. We'll have Lonnie remind everybody about that again. Something worth your time, especially if you're into commercial real estate. Lonnie, I gotta hit this one because this is one of my favorite subjects. Watching this as I've driven around everywhere from Kissimmee to Miami, all over the Panhandle state of Florida. Retail in our region, in some places, it's a dead man walking. Nationally, it's the same condition with Kohl's on the brink, with Big Lots shutting down. These major chains, restaurants, etc., but retail especially. Is it a dead man walking as far as an industry? We're seeing Macy's shutting down locations, Bloomingdale's, on and on and on. Has the consequences of the mall model failing really been measured in CRE yet?
It's a great question, and I would say this is similar to the office discussion we had a moment ago, where you have a bifurcation in the market between the haves and the have-nots in retail. I think you've seen some of these legacy retailers that have not really innovated and not really changed their business model over the last, call it 50 plus years. They're struggling. The one benefit they have is that in most cases, they own some really great real estate and good locations. I mean, there was some discussion around Macy's in particular about, the real estate that they sit on is worth more than the operating company. And so that they're in a position where if and when they decide to pull the plug holistically, they have some real nice assets that they can then sell. Kohl's and some of these others that are not large owners, but just operators of leased real estate. I think it's an interesting time for them because they either have to evolve to what the new modern shopper wants, which I don't think is all e-commerce, but they want more e-commerce. They want more omni-channel delivery. They want more than just bricks and mortar. They're having a hard time kind of finding their place. Now, if you go a little bit lower than that in the spectrum, these local shopping centers and strip malls and other things are on fire. I mean, you're seeing all-time highs in rental rates, you're seeing all-time high in occupancy. So for the retail that has, emerged post-COVID, you're seeing what we would call a retail renaissance. For some of these legacy big box, mall type of retail, it's a continued struggle for them. Maybe some green shoot from that space is when Bed Bath and Beyond, as an example, closed down, Burlington Coat Factory effectively backfilled all of their locations almost immediately. Now, subsequent to that, you've had Party City file two bankruptcies in the last 12 months. You've had Big Lots file bankruptcy twice in the last 12 months and announce they're going to close all their stores. So there's definitely some pain in the sector, but I do think that I'm actually pretty optimistic for retail on the whole, given the fact that for every one of these, big box retailers that have closed, you've seen, generally speaking, somebody come in and backfill. An interesting area to look at, though, going forward is the drugstores, Walgreens, CVS. They've all announced consolidation, store closures. I think at one point Walgreens said they're going to close, I think maybe 1,200 stores across the U.S. Those are interesting because they're specialty purpose built and they're not easy to backfill at scale. And so you'll see some probably dark Walgreens, CVS's sitting on the market for a while until somebody can figure out a scalable alternative use for those. But, to answer the question, I think it's like we talked about earlier. Unfortunately, it's not a one size fits all. There's some retail that's knocking out of the park, but this legacy retail is still challenged.
Well, I wrote my uh, rant about Walgreens many months ago, basically saying when you try to introduce the idea of medical facilities in a retail market, it's not going to fly because who wants to walk by everybody with a cold and flu to buy their groceries or get their prescription? It was pretty much common sense, and Walmart figured it out immediately.
It is an interesting dynamic. I think people underestimate on the business side your point. I mean, I'm the same. Like I wouldn't go in Walgreens unless I had to because I don't want to be standing around a bunch of sick people in a store. Like if I have to go to Walgreens, generally it's to pick a prescription up. I'm going to just go through the drive-through, and so it's an interesting challenge where you want to have a place where maybe you can do a little bit of light shopping and pick up your medicines. But to your point, it's not something that me as a shopper that I'm that interested in, honestly.
Oh, wait a minute. Common sense. What a great idea. They're smart. They spent $200 million on smart door freezers and it didn't do anything but lose money. So I'm right there with you, sir. A lot of retail is common sense. If it's appealing to the customer, they will go there and repeat if the price is right. The idea that Walgreens could not understand that concept blows my mind. And buying Boots Alliance made zero sense as far as the national strategy. So, with that, Ulysses, are you ready to interject here, sir?
Absolutely, especially on this topic. Nice to talk to you both again.
Same.
Welcome aboard, sir.
Thank you. Lonnie, let's paint a picture of sort of where the debt space is for commercial real estate on at least on the CMBS side, because if I'm not mistaken, last year the issuance of CMBS actually increased year over year despite the delinquencies. Is that correct?
That is true. So it was kind of as to go back to the tale of two markets. I mean, that's been one of the overarching themes for 2024, and I think it will remain in 2025. You had elevated distress. We saw significant increases in the overall delinquency rate. We finished 2024 with delinquencies in the CMBS market sitting at just over 6.5%. But to your point, we saw CMBS issuance cross over the $100 billion threshold mark, and we actually had about 108 billion in total issuance in 2024. So once we can get into maybe some of the drivers for that, I mean, primarily the community and regional banks really pulled back on lending given the activity from the Fed on the interest rates and some of the bank failures. So CMBS backfilled a lot of that demand. But to your point, the numbers are very interesting when you have significant. I think we were up about 220 or 230 basis points of delinquency throughout the year of 2024, and then we went from call it around 40 billion in issuance the prior year to over 108 billion in 2024. So definitely a tale of two markets.
I think CMBS actually outpaced whole loan note issuance last year as well, didn't it?
Yeah, CMBS was the lender of choice. We just finished up the CREFC conference the first week of January down in Miami, and all of the experts there were saying that they expect to see CMBS issuance hit about 120 to 130 billion in 2025. So I think While last year was a great year from an issuance perspective, people are expecting us to have an even stronger year this year.
I've got a question. I saw this morning in CRE Daily that it was the first time in 15 years that industrial logistic rents fell year over year. What are you seeing in the market, the mortgage market space for that asset class, given A, how many trucking companies have filed bankruptcy over the last 12 months? And, everybody knows it is the great freight recession at this point. And then, yeah, I'd love to get your thoughts on that, where things are at and where you think they might be going.
Industrial is an interesting asset class in the sense that it has been the darling performer post-COVID, and all of the office institutional capital that used to flow into that sector has effectively gone into either data centers or industrial broadly since the pullback in office. And if you look at some of these large players, I mean, I think Amazon did about 25 years worth of industrial development over a 5-year period. And the appetite has been fairly insatiable up until recently. I was in Louisville, Kentucky last year at an event, and they had some industrial brokers on a panel, and they were saying it was early 2024 that they started seeing a measurable pullback in the demand for these million plus square foot distribution centers, and that players in the market were looking for things that were 250,000 square foot or less. And if they were divisible, that was even better because the demand on the distribution side was waning pretty significantly. And I've seen that across the US. Now, industrial is one of those asset classes. Like I've been in the commercial real estate space about 23 years. And I tell this story when I first got in the business, everyone wanted to be an office broker or a multifamily broker or a retail broker. Nobody wanted to work in industrial. It was like if you had to choose industrial, it was like almost like the leftover asset class. And now it's kind of the opposite. And the office has obviously fallen off in terms of demand. Retail is not as strong as it once was. Multifamily is still, definitely a fine choice for people. But a lot of people want to get into the industrial space because it's transformed itself into logistics, and logistics has a little bit of a sexy feel to it. So there's been this paradigm shift in the market. But when you look at just the data, let's just say from a rental rate perspective, 7 years ago, you could rent industrial warehouse space across the US somewhere in the $5 to $7 range all day, every day. That same space now is probably $12 to $25 a square foot, depending on where you're at in the market. Is that sustainable, that type of growth in this short of a window? I don't think so. And I think what you're seeing is people pulling back, but I think it's reasonable. I mean, I don't think industrial's at risk of falling off a cliff. I mean, Prologis just had their earnings call and had very strong positive outlook. I think that you're still going to see industrial demand. I think you're just going to see it scaled back to where we are in the current cycle, and it won't be anywhere near what we've seen over the last 5 years in terms of new development, the size and scale in which we saw 20 plus years worth of development in a 5-year period.
Real quick question to interject. Sorry to interrupt, Ulysses. In my day and age, it was primarily border locations that were the large logistics centers that we were working on. Do you see a new development, especially under this president, to modernize and improve our port facilities along with our border transportation systems, thus offering opportunities at key choke points for that logistics centered investment?
They should. I mean, if we don't do that, that's, again, going back to the lack of common sense. Like we saw what happened with the supply chain disruptions over the last 5 years, and we had ships sitting out at the port in LA that couldn't dock and offload their cargo. We have several additional port options across the US and the now called Gulf of America that we're not leveraging. We have several other opportunities to develop additional ports for point of entry. We should be making very concerted efforts into maximizing those. And I think if we do that strategically, it will help diversify and maybe eliminate some of this border risk that we have. Now, industrial just broadly has kind of created this new infield development of last mile distribution. And that's where we've seen a lot of the activity. That's where Amazon has really come in and created a niche for themselves in the market of they want to put their distribution centers, literally within a few miles of the major residential hubs in these markets. And so that's where we've seen a lot of this new development and construction. And what's really interesting is you're starting to see homeowners associations and some of the NIMBY crowd really push back on any more distribution development near their neighborhoods because they're tired of, well, we all want to order the Amazon and have it delivered in an hour. We don't want any more semis. We don't want any more train stops. We don't want anything else that's delivering goods to these last mile distribution centers in our neighborhoods or around our traffic flows. And so it'll be interesting to see how just the markets broadly react to this influx of new development. I think the port is a very, it's a complex topic and it's something that requires some deeper understanding, probably more than what I have. But I think we're missing the boat, no pun intended, if we don't put some investment into that going forward.
Well, that brings a follow-up question with the pushback on Amazon, because God knows we've developed about 1 million of them. It's like a Walgreens down here in Florida. It's insane. You can't you can't drive 20 miles without passing a blue warehouse. But on the flip side, your point is very well taken, because there's always been a strong resistance to commercial traffic, be it rail or road. Does that not make Prologis a logical? And this is if you're involved in any kind of merger or acquisition talks. I understand you can't answer that, but does that not make Prologis a logical point or angle for Amazon to continue logistics expansion as they have into the transportation management and distribution networks using their excess warehouse capacity?
Yeah, I think that would be a great opportunity for them. And I think I have a couple of thoughts just broadly on the Amazon stuff. Like one, Amazon has grown at some record scale, both in their digital and their AWS offerings, as well as the physical retail stuff that they do. And I think people underestimate how shrewd they are from a business operations perspective. And my fear for them, this wasn't really part of the question, but just to give you some insight on my thoughts with Amazon, is to your point, they've built out all of these industrial distribution facilities across the US. Now, if you're a developer, this was like heaven sent, where you were getting these calls from Amazon saying, "We'd love to do a build to suit with you guys. Is there any way you can do this? We'll sign a 25-year lease. We'll sign a 15-year lease, whatever the case may be." And the developer's been over backwards to get those things built out for them. The part that I don't think people are fully putting into the equation is all of those facilities are literally built very specific for the logistics, for the freight, for Amazon only. If and when those leases start to roll, Amazon has 100% of the leverage in the negotiation there. So right now, Amazon generally pays above market rents for those facilities because they needed them built in specific locations in a very tight time frame. If and when those leases start to roll over and Amazon says they want to pay 25% of what they're paying today, the owner of that building is not going to have a lot of options because they have really strange land to building ratios relative to other industrial development. The traffic of their trucks on the concrete is very rough, and the logistical infrastructure on the inside of the building make them to where it's very cost prohibitive to convert that to something else. So I think if I'm looking at potential downstream risk for the industrial market in CRE, given the fact that I know how much space Amazon has across the US and what that structure looks like, I think there's some systemic risk in that for the owners of those buildings. Now, to your point, for Amazon, listen, they're connected to all of the major players in the market, and nobody wants to miss out on opportunity to work with Amazon. It's kind of like Walmart in the 80s. And so I think you're going to see them strategically align themselves with others, and they will do what's necessary to make sure their business stays profitable.
On that note, do you see maybe more potential systemic risk in the space if UPS and FedEx continue to shrink in volume, especially with Amazon growing and the potential for them to change? UPS and FedEx own a lot of similar type of industrial real estate, do they not?
They do, and yes, so I mean, that industry is going to have to go through some consolidation at this point. I mean, you have DHL, you have FedEx, you have UPS, you have all these providers effectively trying to compete. You have the Postal Service, which people are trying to put out of business and say we should privatize. And then you have Amazon that's effectively just built their own fleet to compete with. And it's been proven at this point in my mind that FedEx and UPS and these others are not going to be able to compete at scale. And so I think you're going to see some consolidation there. And look, when you get down to just having one or two players in a space, like that's not great for the consumer because costs generally go up. You don't have a lot of choice. And to your point, you're going to have a lot of industrial real estate that doesn't have, viable use in its current the way it's currently constructed. And so we've already seen that at some level. I mean, these FedEx and UPS distribution centers that are no longer in use, there's not been a huge appetite for people coming in and taking those as second gen space when there's been so much new supply added to the market that you could probably get at not too dissimilar of a rental rate and you have a brand new facility. So I do think there's going to be some challenge with that. I don't know, if that's a 2025 issue or if that's something that we see play out over the next 4 to 5 years. But I definitely would be keeping an eye on that for sure.
That's great feedback. What do you see in the medical space, if anything, especially with the recent spate of hospitals, bankruptcies, a couple of large companies having issues in the space? Are you seeing any significant debt distress or anybody discussing future opportunities in that space?
Yeah, it's an interesting part of the CRE market. The hospital space in particular is kind of its own asset class, and you can break that out into the not for profit and the for profit, and you can break that down in further if it's elective type of medical space or if it's stuff that's life saving emergency room type of stuff. I don't have a lot of insight into that data on the macro. I think for the more localized medical office, where you have, your family practice doctors and you have your MRI folks and your X-ray teams and your dental facilities and other things, it's really, really strong right now. I mean, like to the point where the people in that space are making a concerted effort across the US to make sure that we delineate medical office as its own category and not lump it into the broader office market category as we have in the past, because the medical office market has been on fire. And there's an interesting dynamic where you've actually seen some of these large scale malls that have failed backfilled some of their big box space and chopped it up into some medical facilities. And you've seen some of the medical schools through the universities actually take down some of that space and repurpose it for medical facilities. And so I think the medical space, it's a little counterintuitive based on the narrative. You would think that we'd be going more towards, telehealth and on-demand doctors maybe coming to your location instead of you still going to a central location. But it feels like, and the data would suggest in the local medical office market, it's been relatively strong, even though on the broader larger scale hospital stuff, there's been some real stiff headwinds for them.
Unfortunately, I think due to the risk profile, I don't think we'll see doctors calling at home due to the insurance regulations and risks that are involved until we can resolve that part of the issue, to be honest. Quick question, though, to interject here with what Mr. is and following up on that. With the medical issue, is the nursing home defaults accelerating? And it's not just a Florida issue, it's a national issue. What is the CMBS CRE risks associated with that? Because there's a lot of that is securitized at the local level.
Yeah, you're right. And it's an interesting market because it's another one where if you look at the headlines, all you've seen or read the last, 5 years is the silver tsunami and have all these, folks entering retirement age and needing to have some additional housing options, and senior housing is going to be this, great place for them to kind of transition as their latter, years of life. And in practice, we haven't seen that. And I think what people in the real estate space, as I mentioned earlier, I've got 20 years in the space. I've seen a lot of stuff, but I'm surprised every day at things that I've maybe taken for granted or thought would happen that haven't. And the senior housing is one of those. It's effectively just as much operating business as it is real estate at some level. And what you realize very quickly when you start digging into it is some of the operators across the US are not very good. And it's very difficult for them to get highly qualified staff that's willing to stay and come in and work. And COVID put a lot of downward pressure on senior housing, nursing home, those types of, skilled nursing, et cetera. um, use cases because it was a real risk for people to show up to work every day. And so, it's this dynamic where there's definitely a growing need. There's demand on the demand side. Some of the higher end, what we would call their CCRCs, continuing care retirement communities, where they have multi-level of service. You effectively move in as a healthy senior. You then can transition to the skilled nursing facility when you need it. If you need to go into an Alzheimer's or dementia wing, they have that there. It's all in the same building. You don't have to move every time. Those generally have some sort of a 250 to $500,000 type of buy-in on the front end. Those have been doing exceptionally well. For these Class B and C kind of lower tier senior housing, there's some distress. And so I would say in this market, though, given the demand side, you're going to see this sector come back. You just need kind of a changing of the guard and who owns them and how they operate them. So, there's some functionally obsolete, some older facilities that need to have some capital put into them. And maybe with this downturn, you might see some reset in basis where the new owner comes in, has some capital to put into the investment and can turn these around because there's no shortage of people that are going to be needing that type of off ramp as they age and decide they don't want the maintenance and upkeep of owning a home, etc.
Well, that was interesting. And once again, X decided to sit there and take a dump for everybody. And I apologize to that. Uh, Lonnie, please continue because for some reason it decided to take a belch in the middle of conversation.
Yeah, no problem. I think we were just transitioning to Ulysses was going to ask a question, but I was with them dropping us off. I was thinking we would use that as an excuse to have a second one of these in the next couple of months. I've had a really great time today.
Sir, that would be fantastic. And you were great because you answered a lot of the questions. And I always try to end the show with a big question. And my big question, I'll go ahead and interject that now because I don't want to abuse our time with you. You've been fantastic. Danielle Martino Booth, DiMartino Booth, was at the Double Line Conference, and she said, "quote the feedback mechanism from private credit into leverage loans and into high yield. How much of a risk is that into regional and community banks, especially, and also the risk of double defaults as the CRE refinancing cycle starts to pick up speed in 2025 and into 2026? Because it is a risk, I believe, and love to hear your take on that."
Yeah, no doubt that it's a risk. I think the unanswered part of that, and I don't have visibility into it, is that is a very opaque part of the marketplace. So none of us really know at this point how large or how systemic the risk really is. We know that that's been taking place, and as the regulators start putting a little bit more pressure on some of these traditional banks and start delving into where maybe they have, had lines that have been exposed to some of these kind of blind investments on the balance sheet, we're going to see how large that really is. I think it's something that as the markets ebb and flow, as we started off the conversation with the PE talk, and I use the term financial engineering, like we've seen people fill the void that we didn't have available when the great financial crisis happened. And so these private debt funds and others that are in the space now providing capital have done a really great job of kind of keeping the market moving, but they've done that with some stuff that's a little bit opaque on some of these banks' books, and we'll see how bad that risk could be. So I know Danielle. She's been on our show a couple of times. She has a lot more insight into that than I do, having been a former Fed member. I do think the regulators are going to be. They've been really laissez-faire throughout this entire interest rate disruption. In fact, the last official guidance they gave to the banks was if you have borrowers that are unable to make their payments but willing to work with you, you should work with them. They did not want to see the keys being mailed back at anything close to the scale we saw during the great financial crisis. And so that's been what I think, as I mentioned earlier, some of the resiliency of the market has maybe not been so much the market itself, but the fact that the regulators have been so laissez-faire with the banks around mark to market on some of these loans and some of the other stuff that you would traditionally expect them to force them to do. I think 2025, 2026, you're going to start seeing some of that come back where the regulator's a little bit more strict in making sure that the reporting and everything is being done at a level that it should be. And so I don't know how big that is. It definitely is something we're going to be keeping our eye on, because I do think there are downstream implications it could have for the broader CRE landscape. But even with that, I mean, if you look back, we had three bank failures in the period of about 6 months, and everyone thought that the entire banking sector was going to come crashing down. We started paying a lot of attention to CRE concentration ratios, and you had several banks that were 300% plus on their CRE concentration, and would be indicative of some more failures. The Fed steps in, they set up a credit facility, they do all these things to keep the market moving. So I'm at this point. Um, I think the government will do whatever is necessary to keep the lending environment open for business at some level. I think they'll do everything they can to prevent some sort of systemic CRE crash. And I think we've seen over the last 10 plus years that any sniff of real disruption, they've been more than willing to step in and bail people out. So, with that kind of mindset, I don't see some catastrophic event happening, even if what the regulators find is not favorable.
Well, I'm going to come back to that. Is the outsized risk, though, and something a lot of our economics teams predicting, including myself, a 6% plus 10-year yield for even a limited duration from the spring through the summer, possibly early fall?
Yeah, I mean, I think at this point you would have to say that that's a possibility. I mean, sitting where we're at today, given where the Fed is with the federal funds rate and what's happening with Treasury yields, I wouldn't be shocked if we see a five and maybe a six handle. At the same time, I mean, you've heard the new president, which again, it's kind of headline fodder. He doesn't really have the authority or ability to impact that, but he's wanting rates down. So there's just this tug, push pull, whatever you want to call it, in the marketplace. If if some of the geopolitical stuff, if some of this broader macro challenges that we've talked about actually come to fruition, I don't think that's outside the range. At the same time, I could I could, very easily see a rebound where we see the treasury yields come down, we see interest rates come down, and we see, the real estate markets take off like a rocket ship again. So I think, I'm not in a position to stake a claim here, although I think you could make a reasonable argument on both ends of the spectrum to say there's enough evidence on both sides that either of those scenarios could definitely play out in the next 18 months or so.
Thus bringing back the mystery, the most opaque market there is, CDO, CLS, CDS, which of course everybody forgot about, except now it's called bespoke, correct?
It is, that goes back to the financial engineering, right? Like you see some of these instruments come online during moments of disruption, and there's a select few folks that make a killing on those deals until they go south, and so then they kind of go away and people forget about them, and then some other version of it pops up. So I wouldn't be surprised, as I mentioned earlier, like I'm learning stuff and seeing things for the first time every day, and I think disruption creates opportunity. Disruption also creates some bad actors, and we'll see how this plays out. I'm I'm just surprised, and at just how strong the markets have been given all of the challenges. And I don't know if it's because we've talked about this to some level on our podcast of the fact that we live in an information overload society, that it lessens the impact of all of the actual data at some level. And 30 years ago, if we had had one fifth of the challenges we've had to the economy over the last 5 years, it would have tanked everything. But at this point, the news cycle is so prevalent and we see all the stuff every day that it's almost like something that would have completely derailed something, 15, 20 years ago now is just a blip on the radar. We talk about it, and then 3 days later, something else comes up and the market just kind of keeps going. It's a really interesting thing, and I don't know how I feel about it. I do think it lessens the fundamentals, and fundamentals don't really drive the market at this point as much as the narrative does. And I think that's a slippery slope for us as we continue on and look out longer term, 20, 40, 60 years from now. Like the debt that we're incurring as a company, as a country, the lessened impact of real-time data, news, insights, et cetera, I think bodes not positive for us on the longer term unless people start to wake up and start doing some real deep dive analysis on their own on some of these things.
Very good, sir. I'm going to let Ulysses ask his question again because everything got disconnected, but I'm just going to go back to one of my mentors who said, everything looks really cool until the firework blows up in your hand. Go ahead, Ulysses.
Isn't that the truth, huh? Never play with fireworks, Gordon. Actually, I'm curious to get your thoughts on what you see as either a market or an asset class that's outperforming maybe what either you thought or the market thought it would be doing at this point in time.
Um, you might be surprised by my answer here, but I actually think Office has outperformed relative to what I would have guessed it would have done given the impacts of work from home. And my rationale behind that is we talked a little bit earlier about delinquency. Overall delinquency for CMBS was 6.5% at the end of the year. Um, Office delinquency in December peaked out at 11%, which is the highest on record. The previous high watermark was in 2012. It was at 10.7%. We eclipsed 11% in December. And so for some, you would argue, by definition, if that's the highest percentage of delinquency, it's the worst office market we've ever seen. I would take a little bit of a contrarian view and say, for all of the things we know about Office and all of the functionally obsolete Class B Office and all the challenges that we have, lack of secondary alternative use, adaptive reuse, et cetera, the fact that 90% of the offices are still making their mortgage payment, I think, is a silver lining in this entire last 5 years. The fact that they have multiple tenants in most locations, staggered lease dates with rollovers occurring on different time periods and time schedules has allowed them to weather the storm, if you would. And I think, as I mentioned earlier, with the return to office mandates and people coming back to work, I think 2025 you start seeing a rebound. So I think the lack of 50% delinquency or 40% delinquency or offices at scale being sold for pennies on the dollar to me is the biggest surprise of this. I think they're obviously by math the worst performing asset class in the delinquency perspective, but I would argue they've considerably outperformed given if 1/10 of the headlines actually played out, you would have seen 40 or 50% delinquency, and we haven't seen that, and I don't think we will.
I love the perspective because you're right there. Uh, it could be so much worse than it already is, especially given that delinquency rate. The fact that it's doing as well as it is says a lot.
Yeah, if this was any other asset class, hotels are a night to night business. Self-storage month to month business. Apartments year to year business. Retail and office are the only ones really that have, and industrial at some level, 3, 5, 7, 10 year type of lease structure. Like the framework that has made office successful in the past is really what saved it during this downturn. Now, with all of my waxing poetic about office, the offices that have been disrupted, we've seen measured through our appraisal data, on average 40 to 60% reduction in value. And offices, generally speaking, are the highest valued asset class relative to the other classes. And so, if you have a $200 million building that's down at 50%, it's $100 million building. That's no, I mean, that's a real loss for somebody, whether it's the equity holders, the lender, et cetera. Um, and so, I don't want to diminish the challenge the office sector has had because the numbers for office are large, and it's a significant portion of our CRE ecosystem. But to your point, all things considered, I if I had been asked 5 years ago what I thought the ramifications of all this would be to office, I would have been much more bearish than what we've actually seen play out.
You make a good point about the situation too, though. With all the modifications that we've seen, wouldn't it be fair to say that anybody that can modify will modify because nobody wants to take that loss, especially on a 50% of asset value?
Yeah, I mean, that's the part of the equation. And I would equate it to, there's a term in the real estate market called shadow vacancy. So, we used to talk about this in very specific markets like Houston and others, where you'd have large corporate leases, but they never actually occupied some of the space. Like they never took the space down, they never finished it out, but they paid rent every month. So it never showed up in a vacancy report. It was just shadow vacancy out there where the space was dark, even though they were getting paid. Now it's a large portion of the office market. Um, and to your point, like the extend and pretend, the modification, everyone's incentivized. The lender, the borrower, everyone is incentivized to try to extend and not realize the losses. Um, the the mathematical challenge for me in this equation is just that the existing in-place debt on most of these offices that have been financed in the last 10 years, notwithstanding the last two, are at a 4% or less coupon. So you're paying an interest rate of 4% or sub 4%. The term comes due, and you're gonna have to refinance into a 7% rate. And oh, by the way, cap rates that were 5.5% when you financed are now 8 or 9, and the value is obviously diminished. And so, sure, can you extend it for 24 or 36 months? Can you kind of kick the can down the road and keep making the payments, and the lenders keeps getting their debt service covered? Yes. In reality, though, at some point, the math has to come into the equation. Like you're gonna have to take a write down or contribute sizable equity to pay off the loan balance. That's where I think we're gonna get, call it the next 24 months, is I don't have the most recent stats, but let's just say in 2023, there was about $12 billion worth of extensions and modifications. I'll have the year in 2024 stuff here shortly, but in 2023, it's about 12 billion. 70% of the 12 billion had a 12 to 24-month extension window. Those have already burned off. How many of those lenders and how many of those borrowers are willing to go through the dance again for another 12 or 24 months? So I do think in 2025 and especially in 2026, you're going to start seeing a lot of these bank to be a little bit more aggressive on these office and say, we're either going to need you to pay this down or we're going to take it back and take the loss. And we've seen in some of the bank reporting, Wells Fargo and some of these others, they have a much better grasp of what their exposure is. And we did some analysis. They're on the top 100 bank holding companies across the US. We did this about 8 months ago. Um, the office portfolio concentration across the 100 largest holding companies was around 15 to 20% on average. So of their CRE book, about 15 to 20% was allocated to office. Now, 15 to 20% of the 15 to 20% office allocation were non-performing. So when you start looking at what these banks are actually sitting on, it's not enough to bring the banks down. It's not enough to really be a huge detriment to them. And I think at some level, you're going to start seeing them strategically offload some of these non-performing office assets at a haircut. Whatever that number is, I don't know. But I think 25 and 26 will start to see that play out. But for everyone else that maybe hasn't done a modification or an extension, they're kind of just now getting to that maturity window. They're going to do everything they can to push this out another 24, 36 months if they can.
Fantastic insight. I just want to say thank you, Lonnie, for joining the show, and I am looking forward to more MacroEdge and Trepwire collaboration in the future. And it's been an absolute pleasure to chat with you again.
Well, thank you so much. We are thankful to have a partnership with you guys. Can't wait to continue to embed what we do with each other. And happy to join your guys' show if and when you want me to in the future. This has been great on my end, so thank you for having me.
Thank you, Lonnie. And please promote Trepwire, promote the Trepp podcast again, please, so everybody can hear it, because you guys provide information from an investor's and a macro perspective that few people do.
Thank you. So you can find the podcast on any of the major streaming platforms. It's just called the Trepwire Podcast, and we, as I mentioned before, we put it out every single week. They come out every Thursday evening, usually around 10 p.m. Eastern. We also sprinkle in some really good guest episodes where we talk to practitioners or people with specific intelligence around certain components of the CRE or broader economic spectrum. We just had the folks at MacroEdge on and put out a guest episode about 2 weeks ago with them. And so we'd love to have you check us out. It's something that we are very passionate about. It's the highlight of our week. It's myself, my colleague Haley Keene that runs the show, and then Stephen Bushbaum, PhD, that's been on the show with us now for a couple of years. And so feel free to check us out. And if you're in the need for any type of commercial real estate data, analytics, income and expense information, aggregate delinquency data, we do all of that, and we have a really robust product suite of offerings. So you can just check us out at trepp.com for that, and we'd be happy to jump on a call and kind of show you what we can provide on that end of the spectrum as well.
Lonnie, thank you so much, and you might want to forward that to Jay Powell. He might want to start paying attention.
Will do.
This has been a fantastic program, everyone. And please, macroedge.net/ozone, macroedge.net/ozone. Get the 2-week free trial. See the collaborative efforts you're witnessing here. We have a great team, and it's going to get better. Next week, January, was one hell of a month for guests as Lonnie closed it out and brings home everything we're covering. Next week, Friday, February 7th, my honor, and believe me, I can't wait to talk to her, Chief Economist from Bloomberg, Anna Wong. For MacroEdge Radio, this is John Galt. Good night.